Hello, thank you for joining us today. I'm Shiloh Ferreira, and I'm so glad you're here. I'm with Thrive Mortgage, and we've got a lot of information to share with you today. If you haven't heard of Thrive Mortgage, that's okay, you will. This company's been around for 20 years, and we have branches all over the country. We opened 4 branches this summer in Arizona. We have Tucson, Prescott, Phoenix, and our branch here in Gilbert Chandler. So when other companies are closing doors, we're actually, turn off some of that sound. When other branches are closing doors, we're actually expanding and thriving as we do in any market. Our team here, you can go ahead and advance the slide, please, Chris. Our team here in the Gilbert Chandler office are an amazing group of individuals. We have Hector Montero, Al Adami, Jamie Kirkland, and Tori Ledoux. And these are very experienced, very professional, very positive players in this industry. And I'm so proud to work with them. They have a plan. You should contact them because they have a plan to help you through this market. Also joining us today is Tracy Finder with Clear Title. She's an amazing partner, and we appreciate everything she's done to help us pull this together today. So be sure to connect with these folks after the meeting. We love working with Tracy and her team, and we've got some great information to share with you. So please focus, if you will, for just a small portion of your day, because we've got so much to share with you about how this option can help you and your clients. I'm very excited to introduce to you Lori Anderson. She is an amazing leader who has 24 years in lending, 10 of which she has spent helping folks specifically with the reverse lending options. She was introduced to lending, and she was introduced to reverse mortgage when her mom got one years ago. So that helped her and her family, and she went on to serve 80 families with reverse over the course of 10 years, a total of 675 families. She's got a heart for her clients, and she explains things so well, and I'm honored that she's taken us under her wing to help us help mentor us in this amazing option for seniors. So with Wisdom Senior Living, powered by Thrive Mortgage, I'm so happy to introduce Lori Anderson today.
Thank you, Shiloh. I appreciate it. You guys are a fabulous branch that we have brought on here at Thrive, and we are so excited to have you guys from Arizona part of the team. And you guys, whoever invited you today, you are with no better. You guys have got some great loan officers in your court, and you could not do any better. Thank you for taking up the time today. I'm going to this topic. We could talk hours and hours and hours about this topic, and I'm going to hopefully be able to give you some information, and I'm going to kind of jump from different topics to different topics, and then we're going to have a Q&A at the end. So if you've got any questions or anything that is on your mind, you can pop it into the chat log. Shiloh's going to be monitoring that for us, and then at the end, if you do, Shiloh and I, we could turn your mics on, and you guys could ask any questions or anything like that. And I kind of want to give you guys a brief little overview of Thrive. And again, you know, Shiloh said that we have been in business since 2001, and the owner of the company used to bank with me at the bank. I used to be a commercial lender at a community bank here in Georgetown, and he used to do the permanent loans, and we would do the construction loans. He business banked with him, and I thought so much of them that I joined them about 10 years ago. Well, back 15 years ago, my mom had a reverse, and I got the mortgage statement, and I thought, Mom, what did you do? I don't understand what it is that you've done. I didn't understand the product. And I'm going to talk about one fear that I had with that I learned was not true. I'll talk about it in a future slide here. But then fast forward, I started with Thrive in 2012. And we bought on a branch. One of our branches was a reverse only branch. Now, I know all of the loan officers that have invited you today are forward loan officers and reverse loan officers. And I can tend to think that that's a good thing, because, you know, we can hopefully help you and educate you in forward loans, kind of like I say, give you door number 1, door number 2, door number 3, door number 4 of some options with your mortgage and some choices that you've got. And that's a good thing. And because of my commercial background in banking and that type of thing, I really gravitated to the product, and then really went to being able to kind of understand the product. And my mom had one. So again, like I said, I really think that that's going to really hope and help you guys. So my first thing is why are we here? What's going on in the market? Everybody is being able to see these things, and it's very scary about what's going on in the market. And it's why are we here? What are we doing that is, you know, hopefully being able to make cash is king. Cash is king in this market. And Chris, can you go ahead and advance to our next slide there? I really just want you guys to know that I'm here to answer your questions. I'm here to hopefully, if you're a client, be able to give you some information. If you're a mortgage loan officer that's new to it, or if you're a real estate agent, we're here for you. So Chris, if you could just go to the next slide, that would be great. When you guys hear the word reverse, the very first thing that you always hear is negative. It's scary. You don't understand it. You don't know what it is and why and what is going on with the product. And I can tell you that there are a lot of stories out there with reverse. There's a lot of things out there that people don't understand. And I promise you 2 things. 95% of what you hear is because someone doesn't understand the product. They don't understand, and they're misconstruing what they've heard and turning it into something negative. And I'm going to show you some information that's going to be able to help combat that hopefully you guys will be able to take back and share if somebody ever has something to say to you about the reverse mortgage being a negative, or a reverse of a loan of last recourse, that type of thing. But the other thing that I really want to challenge you is, maybe after today, if you ever hear of anything that somebody says and you don't know if it's right, all you've got to do is, you know, and say, you know what, I think I know somebody that can answer this question, and then call Shiloh, call one of her loan officers, and be able to say, because we can get the answers for you and help educate the world on this product. The first thing I'm going to tell you is the very, very first reverse mortgage was a woman named Nellie Young. And she had her husband pass away. He was a local coach in an area where it was a small community, and she only had her house. She didn't have anything else to fall back on. And so in the early 60s, I think around 1961, the local bank made a reverse for her. And what they did is they gave her some of her equity back to use and did not charge her for a loan payment. And that's the first documented reverse. Now, fast forward into the 80s, and President Reagan signed it into law. And then fast forward, now I'm from Texas. Now I'm licensed in multiple states, but I actually live in Texas. And so Texas there's other states that adopted it around in the late 1992, 90, wherever, kind of about there. But then Texas, we finally adopted it in 2005. And the reason why I point that out is everybody knows Texas is so conservative on their lending rights on your homestead that we adopted it in 2005. And in fact, Thrive Mortgage was the first reverse mortgage purchase in Texas. We closed it in the Longview area. So if Texas has adopted it, it's very, very adoptable, very, very commonplace nowadays. Now, this is what else I want you to think about is you've got a conventional loan, a VA loan, an FHA loan, an USDA loan, and the reverse loan. This product is FHA. It's regulated by HUD, governed by HUD, and it's insured by FHA. It is a very, very safe mortgage. And if you take and compare the closing statements to any of these other government loans, they're going to be very, very similar and have the same bunch of fees packaged together. And it's a very, very safe product. It is established by Congress, and it is part of Section 255 of the Housing Act. And I'm telling you these things because I want you to understand that this loan, it's all about the education of the product of this loan. And what it does for the borrower, the end user of the product, is it changes the risk for the borrower. What are borrowers over 62 worried about? They're worried about outliving their money. Are they going to have enough money to live? And let me tell you this, is if you take a deed of trust on a forward mortgage, it says it's a 30-year term most of the time. All deeds of trust have to have a term. And it says that if you don't pay, you don't stay. Well, what does that do for someone that's over 62 and they do a reverse? Their deed of trust now has a date of the youngest borrower's birthday of 150 years old. So that means that that deed of trust is in place for the 150th birthday of the youngest borrower. And as long as they pay their property taxes, pay their homeowner's insurance, any HOA if applicable, they live in the house as their primary mortgage, and they don't let anything get in front of that lien, then they can age in place and have the protections that they have on this loan. The next slide here goes over a lot of borrower protections. The homeowner remains the sole owner of the house. It's a loan, just like any other loan. This is probably the #1 myth of it, is all we're doing is transferring servicing to somebody else. And it's the only loan that I know of that is insured and governed by HUD and also has FHA involved, that does not require a payment. And what it also is a non-recourse loan. There's paperwork signed at the closing table that tells the borrower that there's non-recourse loan. And that is one of these bullet points on here. So what it does is the loan, it does not show up on the borrower's credit report anymore. And if something happens to that borrower, we kind of consider it a collateral loan. And so I'm going to walk you through just a little scenario of this. Is, let's just say that my mom, she's in a reverse mortgage. Her house, she paid, it's worth probably about $350,000, maybe to up to $400,000 right now with what's going on with the market. And if her reverse mortgage is at $100,000, what's going to happen is if something happens to my mother, the first thing that I'm going to do is I'm going to go call a real estate agent. I'm going to find out what the house is worth. Is it worth 300, 350, 400? Then I'm going to go back to my mortgage statement and I'm going to say, all right, what did mom owe on it? She owes 150,000. Well, there's some equity there that's mine. It's not the bank's. It's mine or my estate's, mine and my sister's. And so I'm going to go tell the servicer, yes, we want to sell the home and we want to put it on the market and sell it. And as long as we do that within 30 days, they're going to give us 6 months with 2 extensions up to a year to sell that house. Now, the recourse version is, let's say the world, kind of goes to hell in a handbasket or whatever, and the property taxes decline so much that she lives to be 150 years old and the house is only worth 250 and she owes 255. They're not expecting me to collect and pay that. They're going to sell the home, retire the debt on that, and if the borrower, the bank, is upside down or owed anything, they're going to go back to FHA or the HUD to collect the premium. So there's no debt or anything that's expected from my mother, the estate, or the heirs. And when my mother got her reverse so many years ago, that's what I thought. She lived in an area that was a stick-built house and she had manufactured housing around of her. And I thought, oh, values are going to go down, balances are going to go up, and I have to pay that. And that's so not true. And again, these are some questions, like if you have questions at the end on this part, we can kind of go through it. There's third-party counseling involved with these loans. So there's a protected class of anybody over 62, and they want to make sure that no one's forcing them into it, that they understand, kind of like first-time home buyer classes. We do first-time home buyer classes for somebody that has is getting down payment assistance. There's never any prepayment penalty. We have anti-steering regulations and fees for excessive fees. We cannot charge over excessive fees. And the proceeds are not taxable. So there's a lot of borrower protections in there that's going to protect the borrower. So now I'm going to transition a little bit. If y'all got any more questions about the details of what a reverse mortgage is and how, we can answer those at the end, but I'm going to kind of transfer here over to a reverse mortgage purchase and qualifying for some of those things. So basically, let's just kind of look at, you know, somebody that's a senior that's on a existing income of $38,000 a year, and let's say that they, you know, want to either buy a house or refinance and be able, well, in this situation, they're going to purchase a house for $515,000, but they only make $38,000 a year. Let's say that they've got the loan amount of $290,000. Their principal and interest payment on that is going to be $1,925. They're going to have taxes and insurance, so their total housing payment is going to be $2,837. Let's say that they have a little bit of credit card debt, so their total monthly expenses is going to be $3,051, but their monthly income is only $3,167. What would we normally do on a forward loan for that is their debt to income ratio, if you're calculating, it's going to be 96%. We're going to deny that loan. And with a reverse mortgage, we can so do that loan for them. And so part of what I want to kind of think about is this loan, you have, and this is true for whether you're doing a forward loan, a reverse mortgage purchase or a refinance of it, is you basically have, most borrowers have their checking account, their savings account, they have a money market, they have 401ks, pensions, and then they've got the house. By being able to pull the equity back into the house, it gives the senior so much more buying power and being able to make sure that they don't run out of money and outlive their money. And so basically in this situation, if a borrower's trying to sell a house and downsize into a house, they're able to afford that, because when a senior gets to be on a fixed income, they're not always going to qualify for a traditional house. So the next slide here is, let's just say that you've got a mom and dad and they live, you know, in a different town where they're going to sell their house and they need to downsize to their house. So let's say they're selling their house at $500,000 and they're going to be looking, well, and actually in this situation, so their current home that they're going to buy is for $350,000. They're going to pay closing cost of $28,000, and they're going to walk away from the sale of this house of $350,000. They're going to walk away in their pocket of $322,000. So they're going to purchase a new home for $250,000, and most of the time you would think, well, let's just take that cash, and we're going to end up in our pocket $72,000. In their pocket, because what they're doing, again, they're going to take a house that's worth $350,000 minus the realtor fees. They're going to pay cash for another house, and they're going to be able to pocket $72,000. If we go and do a reverse mortgage purchase on this customer, same scenario, they're going to get a loan for $117,000 and be able to just put $150,000 down and put in their pocket $171,000. So that kind of brings me to why someone with why do a reverse mortgage? It's a loan like any other loan, but why borrowers do a reverse mortgage and their motivation behind it is different than a forward loan. So when Shiloh and loan officers sit down with borrowers, you really have to kind of think through options, because they can either do nothing, but then they can also then look at options that's going to make them outlive their money. And when you talk to any senior, what do? They're very, very worried about running out of money. So think about it like a plane flight. If you're going to get on a plane, you don't want to run out of gas before you get where you're going. The next slide here is on some disbursement options for a reverse mortgage. So let me give you an example here. Let's say that basically you've got a home that's worth $450,000, okay? And this scenario, they don't have a mortgage loan. So they're going to be able to pull money out of that. So if what you're doing is if you've got a home that's worth $450, normally on a forward loan here in Texas, we can do 80% and pull out 80%, and then that borrower can have funds to live on. But guess what? It's a traditional mortgage that's going to have a monthly payment due per the deed of trust. They have to make a monthly payment, and it's got a 30-year due date. And they're going to have to requalify if they do any type of home equity line of credit. They're going to have to requalify. On a reverse mortgage, what they're basically doing is they're taking the age, they're taking what the home is worth and the interest rate, and they're pulling equity out, but they're leaving a cushion of equity in there for future, but they're also giving a little bit of a cushion for no payments to happen. So basically what they're doing is they're pulling that cash out, and they can pull the cash out in multiple ways and use it multiple ways. They can pull out a lump sum of cash. They can pull out, they can pull it out in a line of credit. They can pull it out in monthly disbursements. So let's say, and Chris, go ahead and go to the next slide. And basically this is an amortization schedule for a loan. And basically what it is it's taking a maximum claim amount, which is your loan amount. I mean, your value is the appraisal amount of the home. The home is appraised at $450,000. This borrower is going to have a line of credit of $150,000 that they could pull out. So they own the home, $450,000. They're going to be able to pull out around $160,000. They can take that $160,000 out in multiple ways. Take it out in cash, take it out in a line of credit, which I'll go into that in a minute, or they can take it out in a term or a 10-year payment, or they can do any combination of those whatsoever. They can, I've done loans for borrowers where it's been husband and wife. They left all that cash there in a line of credit. One of the borrowers passes away and they need to supplement the income, so they call the servicer, change their distribution status with easy as a phone call and a $30, $40, $50 fee, and then they can get a monthly payment to reimburse maybe lost income. But in this instance, this is a very powerful piece. Most of the loans that we do are for a line of credit. They leave the cash in a line of credit because there's an earnings credit or a growth rate that's applied to that. And if you look in this situation, if you look down where it says line of credit, they start off with a line of credit at $159,000, but in year 5, if they do not touch that line of credit, their line of credit grows to $229,000 in year 5, and it grows to $330,000 in year 10. So let's take, for example, a borrower that, me, for instance, I'm 57 years old. I hope to work till I'm 67 years old, but the minute that I become 62, I can go do this reverse mortgage. My house is paid off. I can let this money sit there and grow at the exact same rate as, if you look up at the top here, the expected rate is 6.82. So if I pull money out to go on a trip, I'm going to have a loan balance that's going to be earning that, but at the exact same rate that's that, my line of credit is going to be earning an earnings credit at that exact same rate. This is a very, very unique thing that financial planners have added to their instructions, and we've been getting a lot of referrals because this is a tool that's going to help them pull money out of their equity, out of their house, and not have to pull under managed assets. And it's a very, very powerful thing. The next 2 slides are basically some examples of how you can use a reverse mortgage. And let me just kind of take you through those, and then let's open it up for questions, because I bet you we're going to have some questions on this. Let's just say that you've got a borrower that their average household that they spend is $47,000 a year. They've got $20,000 in Social Security and they're ready to retire. And the only money they have is they have a house that they own free and clear, and they have $198,000 in a 401k balance. And they're trying to decide if they're going to have enough money to last out their lifetime. So if they only do pull from their 401k balance, the average what they're spending. So basically we just took what they spend. Their 401k is going to last until year 9. That's basically saying that their 401k would last them 8.5 years if it had a 4% annual growth. And then after that, they're going to have nothing left but the equity in their house. And the only way that you can pull the equity out of your house is either to sell it. You can't take it with you, do a forward mortgage and have a payment, or do a reverse mortgage and have an optional payment. If you go to the second slide here, this is the exact same borrower that they're coupling a reverse mortgage with their funds in a line of credit on a reverse mortgage. And look, they're going to be able to last until year 18. And that's when their 401k is going to be out of money. They're pulling $1,000 a month out of their 401k. The balance they're pulling out of that line of credit. And in 18 years, they've still got $100,000 left, over $100,000 left in their line of credit. And then if they were to continue to pull out, then they would actually last until year 22. But it's basically just showing you some numbers of how you can couple this with some financial planning for the future. And there's very extensive work that's been done out of Texas Tech. They did a study on this, and there's slides after slides of things that they've done that's been able to show why this needs to be a part of somebody's future and planning. I'm going to kind of stop it there, Shiloh, and maybe think that you guys want to kind of pop on and maybe hopefully if y'all got any questions, we can talk about things. I know that it's been we've kind of hopped around a couple of things because it's very difficult to take this product and kind of educate people. And what I find is I usually will sit down with borrowers and then they'll think about it a week and they'll come back and they'll think, no, wait a minute, what did she say? Or how did she say it? And it's almost like sometimes people are making it too complicated, but it's really just a loan, and you just kind of have to peel away the layers and understand, but it can be a very, very important piece of somebody's future. So Shiloh?
Thank you so much, Lori. You did a great job of explaining that. It's really kind of an eye-opener. So what you'd want to do if you have questions, if you have a potential client, maybe you want to know for mom and dad, maybe you want to know for yourself. The next thing to do is get in contact with your loan officer, and your loan officer, backed by Lori and the entire Wisdom Senior Living team here at Thrive, is going to be able to get you the answers that you need. But we do have some questions. Nancy wants to know, it may be a good solution for my mom. How can we get started? So that's the first thing, Nancy. You want to get a hold of your loan officer. The loan officer is going to have some questions about, what the value is of the home, how much is owed against it. They're going to have a few questions for you, and we're going to make sure to give you the answers that you need. And Lori's going to help make it clear so we can see what's behind door number 1, door number 2, door number 3, and so forth. So definitely look over your options.
Shiloh, let me add to that. Part of what I think that when we sit down with somebody, we're not trying to sell them anything. We're just trying to give them some options. And so the only information we really need is their date of birth, what the house is worth, if they owe anything, if there's another borrower, and that's really it, because we can put that into the system and then talk through options and show you what the differences of what it can make and how the difference it can make and in where your certain situation is. And it usually takes a couple of meetings, for someone to really totally kind of get their head wrapped around it. And then the other thing is the counseling. The counseling is a very, very important piece of that, because think about it. Anytime that we've got a first-time home buyer going through it, this counseling is the exact same thing. It's purely an educational type counseling that then can reiterate, hear from a third party, and kind of understand what the product's all about.
All right, we have another question from a couple of people. Can the reverse be refinanced or sold or paid off? What are the choices there once somebody's in a reverse?
Say that one more time. You cut out for just a little bit.
Sure. A couple of people had the same question. Can a reverse mortgage be refinanced or sold or paid off? What are the options once somebody's in a reverse mortgage?
Remember, this is a loan just like any other loan. And so there's things that affect it. It's your age, your date of birth, and the interest rate and the value of the home. And so I have done, it's called a HECM to HECM refinance. And I've also then done a reverse mortgage for a borrower, and he literally sold the house and bought across the street and did another reverse mortgage. And I have somebody right now that's moving in the same neighborhood that she's doing the exact same thing. So it's a loan like any other loan. And with the market fluctuating, things like that, what we do is we just look at the situation and see if it's going to be as a tangible benefit to the borrower. But yes, ma'am, you can do that. And that's the other thing is I've had people do these loans for short term and then end up moving or doing something else. And because you can do this loan and continue to make a payment. In fact, that's what my plan is I'm going to do the loan the minute that I can, continue to make payments and pay into the loan. And then when I decide to quit working, then I just quit work. And so I've got another borrower. We've got several instances where we've done that and they've continued to make the payment. And then it's just not expected. You don't have to make the payment.
Wonderful to have options. Stephen would like to know, is the reverse mortgage only for a primary residence, or can it be on a second home or a rental?
It is only for a primary residence. It's very sensitive to owner occupied. And think about it like this: when Congress was putting this into place, they were doing it to help seniors age in place. So that's the big thing about it, is it's designed to have seniors age in place. Now, you can take those funds, you can go buy a second home, go buy a motor home. If you want to pull money out, you can own multiple homes. They just want your primary purchase, the primary residence to be, the loan to be on the primary residence.
Okay, also, Stacy mentions that she's got this in mind for her mother. Mom has some medical collections that are dragging down her credit score, and wants to know if these medical collections can disqualify her from being able to qualify for a reverse.
Basically, one of the changes that was made, and I believe it was 2017, that's been very, very good for the product, is we added a financial assessment in there. And the financial assessment is we do not look at credit score. We're not really too affected by credit score. And the reason why we pull credit is because we want to verify that mortgage on there and make sure that we're paying off that. But really what the change was is Congress and HUD was trying to protect more equity for the borrower. And so what they did is they did a financial assessment. And so all they're going to do, and when we try to pre-qual a borrower, is to make sure that they can have the funds to pay their homeowners insurance, their property taxes, and any HOA, because we do not want anything to get in front of that lien and jeopardize that lien for the borrower. And so it's a very kind of like a VA residual income calculation that we used to do. And I can tell you that there have been several loans. Some of the ones that are more dear to my heart have been in situations where they are trying to financially. This gentleman retired and he used up his income, and they were running out of income, and we were able to do that. And they did have some negative things on their credit, and we were able to make them. Do you see what I'm saying? People do the loan and then they get into their retirement, or before they do the loan, they get into their retirement situation and they think, oh, we didn't plan well enough. And so let me put that and pull that equity out to be able to last longer. And that's a very key aspect. So we don't really look at some of those things. It's more of a big picture financial assessment is how we approach it.
All right. Here's another one. A 62-year-old just inherited a free and clear property. It is her primary. Can she do a reverse right away on that property?
There are some guidelines that we do have to follow for that. And you cut out again a little bit, say that it's their primary residence.
Yeah, a 62-year-old inherited a property that's free and clear. And it's the primary residence, and they want to know if they can do a reverse mortgage on that right away.
Yes, yes, you can. You can, I've even done reverse mortgages where they bought the house for cash and then we turn around and did the reverse mortgage immediately. So yes,
Okay.
we can do that too. Mhm.
Tracy's asking if you can go into the age requirements.
So yes, the age requirements. Like I said, I'm licensed in several states, and each state's a little bit different. But y'all know Texas is very conservative. You guys are in Arizona, and the HECM home equity conversion mortgage, the FHA backed mortgage, one borrower needs to be 62 or older. So if you're married and one borrower is above 62 and one is under 62, then we can do the loan for you in every state but Texas. Now, this loan has become very, very strong, very, very viable loan that there are now investors out there doing proprietary products that are exactly like the reverse mortgage. It's got a no recourse clause to it, just like the reverse, and you can do those loans at 55. And it's just not FHA backed, which is a good thing. And they're just structured a little bit different on interest rate, but those loans can be done down to 55. And we've got multiple investors that can do those. And that's the other reason why I think I feel so strongly about the product, is because it's not just this loan of last resort. I mean, people, this loan is, I mean, you fast forward into 15 years and this loan's going to even be more prevalent than what it is now. And people are going to go, oh, reverse mortgage. It's just like the VA is to us, or all of these other loans, because it's a government loan backed by HUD. And now we've got other investors out there willing to do that down to 55 years of age.
There's also a question about what property types are eligible for a reverse.
FHA, just follow your FHA guidelines, because generally anything that's under FHA we can do. I've done them on manufactured housing and all of them, so yes.
All right. If there were any questions missed, because it's typed very small and I can't quite see it very well, if there were any questions missed, please feel free to type in the question again, or raise your hand and we'll give you the mic. Oh, it looks like Al has his hand up. Let me figure out if we can give Al the mic. Al, you're self-muted. If you can turn on your own mic, that'll work. Can't hear you, Al. Nope. I can hear you through the window. Just say it loud and I'll repeat it for them.
I have a problem with the computer. What types of properties or restrictions?
Oh, he was asking again, what kind of property types or restrictions? And she just covered that. She mentioned FHA guidelines.
Yeah. The only thing is just if you do have somebody that you think's very interested, just check with somebody, because most of the guidelines are pretty much like what you would have on a forward, but there are some little caveat things that's very different. Like for one, you know how you can pay down debt on a regular purchase, you can pay down debt to qualify for it. You can't do that for a reverse, but there's some just very little different things. The documents and some of the things that you get together on these loans, it's a lot easier process. And the last thing that just made me think about, like on a reverse mortgage purchase, I tell borrowers, and I tell the listing agents and the borrowers, is this loan has got less qualifications less things that can fall through. Like if you've got two offers on the table and you've got an FHA or somebody that's kind of barely going to qualify versus a reverse mortgage, I'm going to take the reverse mortgage all day long, because there's less things that can hold that loan up, less underwriting checkpoints than a traditional loan, because we're not qualifying them on income things. Yes, it may take maybe a week longer because it's got a different type of loan, but it's very safe loan, and there's less, I collect less paperwork, there's less things that the underwriter's checking for. And so it makes it a very safe loan when you've got a reverse mortgage purchase and you're talking with a real estate agent on that other end and trying to walk them through. Don't panic, it's a reverse. It's actually very, very safe. You're going to get to the end a lot quicker than you really realize, and it's going to there's less things that can happen that can cause somebody to fall through like they do on a forward loan.
Right. And there's a lot of people in this room today. We've got loan officers, we've got clients that are looking maybe for this for themselves, or maybe mom and dad. And we've also got some professionals in the room that are, providing good and wise counsel for their clients. We've got realtors in the room, we've got financial advisors in the room. And as a realtor, it's really a great program, because, what traditionally the only option was, if they're right sizing their home and they sell their property and they're wanting to buy a new property, they're buying that new property with cash. And right now, with where the property prices are, that might not get them a whole lot of home, if any at all. And no commission for you. Where this is a great new option, because not only can they qualify for home, they can qualify for a lot more home. And that's important. Obviously you have their best interest in mind, but it doesn't hurt to get a commission as well. And then for the financial advisors in the room, I mean, the whole goal is to help them long term, right? Keep their portfolio whole, to have them not keep pulling money out of their portfolio month after month, and really be able to outlive their savings. And so this is really a great option, because one thing that everybody has right now, if they've owned their home for more than 5 minutes, is they've got equity. So this is a great option, not only to help them keep their portfolio whole, so that you can do the things that you need to do to help them grow that and leave that legacy that they want to leave. But also it's great for the clients in the room as well, because to have options, you can choose to pay the full principal and interest like Lori was planning on doing. You can choose to pay the interest only, and your balance would stay the same, right? You can choose not to make a payment and your balance is going up, or you can choose to actually receive income from it every month and your balance is going up even higher, but you don't care because your equity is also going higher, right? So there's a lot of options here that we have right now today in 2022, 2023, as we're entering, that it really is not only a great program, but it's a really great program right now. And there's so few options out there. This is something that can really help a lot of folks.
Yeah,
so
this product is really, the longer that I'm in it, the longer that I do these loans, it's something that everybody needs to be able to everybody's got a parent, everybody's got a grandparent. And I don't know about you guys, but I have not saved enough for my retirement. And there are so much equity out there that people have access to, and why go do a loan when you can have one that's going to have an optional product? And there's not anything else out there that's governed by the government, insured and backed by the U.S. government, that's not going to require a payment and be able to still keep you. And that's the other thing is they've made so many changes on this to protect equity. You should never, usually and in most instances, never be upside down. You're always going to have equity at the end, but you're just pulling that equity out to use while you're alive and while you're living in the home, and being able to use that, because there are fear of making sure that someone doesn't outlive their money and be a burden to their family or their two kids or whatever it is that they've got. And so we very much encourage you to at least just educate yourself. And if you hear anybody out there that wants to just say, I think I know somebody that can help you there, and point them in this direction, because we really truly want to help borrowers and help seniors and help realtors understand the product. So thank you very much for your time today, Shiloh, and everybody that's on today.
Well, thank you again. You did such a wonderful job of explaining. Remember, the conversation can start with something just as simple as, how's mom and dad doing, right? Ask the questions, get them in touch with the loan officers. We're going to get the support you need to get your questions answered. Thank you for joining us today. We really do appreciate it. What you're going to expect next is an email. It'll have a recording of this video, and also some content that you'll want to look through. So thank you very much again. Get in touch with your loan officer with any questions.